Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Wheels Up Experience Inc. quarterly report. Wheels Up Experience Inc. offers a wide range of private aviation services to individuals, small and medium enterprises, and corporate customers. The company's services include private charter flights for passenger groups, sports teams, and global events, wholesale charter services, group charter and cargo flight services, maintenance, repair, and operations services, fixed-base operator services, safety and security services, government, defense, emergency, and medical transport missions. The company operates through a fleet of 154 owned and leased aircraft and provides customized solutions for its customers. Its membership program includes individual and business memberships, as well as custom enterprise solutions. Wheels Up Experience Inc. Stock price drop. A year of financial struggles. The stock price of Wheels Up Experience Inc. (UP) has plummeted by 41.18% in the past year due to a series of concerning financial events. The company's persistent struggles with declining revenue, widening losses, and negative equity have raised significant red flags for investors. Key factors contributing to this decline include disappointing earnings reports, including a Q3 2025 report showing decreased revenue and increased net loss. Additionally, Wheels Up has reported negative equity on its balance sheet, indicating sustained operating losses and heightened downside risk. The company's premium valuation, with a price-to-sales ratio of 1.1x, is also difficult to justify given its persistent unprofitability. Furthermore, the departure of key executives in September 2024 may have introduced uncertainty, while overall revenue decline over the past year has undermined confidence in a swift rebound. With revenues falling by 20% and 45% over the last 3 years, investors are increasingly skeptical about Wheels Up's ability to recover from its financial struggles. The primary drivers of revenue growth for Wheels Up are multifaceted and include the introduction of new aircraft models, fleet modernization through strategic acquisitions and leases, increased utilization of aircraft, and the launch of its signature membership program. Additionally, higher charter activity during peak periods and growth in membership programs contribute to revenue growth. On the other hand, revenue decline is driven by several factors including the retirement of legacy aircraft fleets, sale of owned aircraft, a significant decrease in members year-over-year, and a decline in ground services and sales of inventory aircraft. The absence of residual aircraft management revenue also contributed to the decline. Net income and profit margins. A decline in performance between Q3 2024 and Q3 2025, the company's net income underwent a significant shift. What was once a gross profit of $14,560, 7.5% margin, turned into a loss of $1,318, 0.7% margin. This drastic change indicates a decline in performance. Profit margins also suffered, decreasing by 2.1 percentage points from 14.8% to 12.7%. The reasons behind this downturn are unclear, but it is likely due to either reduced revenue or increased expenses. Whatever the cause, the company's financial health has taken a hit, warranting further investigation and potential adjustments to get back on track. The company's financial performance indicates a concerning trend. Despite its efforts, the business is currently unable to generate positive operating cash flow. This suggests that the company may be struggling to manage its expenses and investments effectively, potentially impacting its long-term sustainability. The company's debt level and interest expenses have undergone significant fluctuations over the past year. While total debt initially decreased by $6,691, it later increased back to its original level due to a combination of redemption and issuance of new notes. Long-term debt experienced a temporary spike before returning to its initial value. Interest expenses also saw notable increases in certain periods, with cash paid for interest decreasing by $3,601, but then rising significantly in subsequent months. However, the overall trend is not consistent, with some periods showing substantial increases, while others remain relatively stable. Management is optimistic about the company's outlook, driven by several key strategies. The evolving membership program, particularly with the introduction of Wheels Up Signature membership, is expected to increase revenue through membership funds purchased. Fleet modernization will continue to drive growth and innovation, with a plan to modernize the fleet by 2025 through sales and leasing of legacy aircraft. The company aims to achieve $70 million in annual cash cost savings through various initiatives, which will be fully reflected in financial results by 2026. Strategic acquisitions, dispositions, and leases will also support the fleet transition. Management anticipates growing the business with increasing total gross bookings, private jet gross bookings, and improved on-time performance and completion rates. Overall, management's strategy focuses on investing in a modernized fleet to drive growth, innovation, and cost savings, positioning the company for long-term success. The company has made several key acquisitions and divestitures to optimize its operations. Key acquisitions include business combinations, purchasing or leasing aircraft, acquiring other private aviation operators, and entering into alternative financing structures. On the other hand, the company has also engaged in strategic dispositions of underutilized assets, selling current owned aircraft, and returning certain leased aircraft. These moves aim to streamline operations and improve efficiency. Based on the financial summary provided, it is clear that the company has engaged in share buybacks. This indicates that instead of distributing profits as dividends to shareholders, the company has chosen to repurchase its own shares from the market. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights concerns regarding inventory buildup, which poses a significant risk to its operations. The presence of a substantial reserve for excess and obsolete inventory on page 15 indicates that the company has accumulated more stock than it can utilize. Furthermore, pages 46 and 52 reveal that parts and supplies inventory are deemed in excess, leading to increased non-cash charges related to obsolete or overstocked items. These findings suggest that the company's supply chain management is inefficient, resulting in unnecessary costs and potential losses due to unsold inventory. The buildup of inventory can also disrupt the supply chain, causing delays and impacting customer satisfaction. To mitigate these risks, the company should reassess its inventory management strategies and explore ways to optimize its supply chain operations. That concludes the financial summary for Wheels UP Experience Inc. Feel free to comment below, and I will be happy to answer them when possible.